Good, thank you. Good morning, and nice to be here again this year. And it's a privilege to be keynoting this to kind of kick things off. It was nice seeing many of you last night at the CEO dinner, and look forward to catching up with you. And those that were not in attendance, look forward to spending some time during the course of the day today. But Ahmed has worked very diligently again, along with the SoCalBio board members, of which I am one, in pulling this together. I think we have a very interesting, exciting agenda during the course of the day today, featuring a number of the emerging growth companies here coming out of many of the top universities. We have some very interesting panel discussions, and I think the opportunity to kind of network amongst and between ourselves is also quite profound. So let me start by just a show of hands here. How many companies are currently in the market trying to raise capital or contemplating to raise capital in the next 12 months? So that's quite a few. How many companies have already raised their seed round or seed round? Let's start with that. Raise your hand. How many companies have raised their A round? Very few. And how many have raised B rounds? 2. And are there any public companies in the audience? Okay, 0. Good. So that means there's a lot of upside here.
There's one on your panel. A couple on your panel.
Good. So we'll get some lessons from these gentlemen too of how to get there. But we're going to speak today about the whole ecosystem. That's a term you've heard me use in prior conferences here, but it's critically important. There's an ecosystem at the national level to fund this industry, but then there are also regional ecosystems. And we're right on the cusp of starting to develop an ecosystem here in the greater Los Angeles area. When you look around the country, we have some great ecosystems that exist already that have spawned, hundreds of companies and raised billions of dollars of capital. The obvious markets are San Francisco and the Bay Area, Boston, San Diego, the Research Triangle down in North Carolina, the Mid-Atlantic region in and around the Baltimore, Washington corridor, and so forth. But Los Angeles has lagged those other regions. But I think we're on the precipice of breaking through. So with that, I'm going to give some high-level remarks just about the state of the funding environment right now in the capital markets. And I think it will set the stage for an interesting discussion amongst the panelists. But we want to make it very iterative and very interactive with you in the audience to fire questions up to us. So let me get going. So let's talk about the equity markets, because this is an industry that really drives on equity. It's not a prolific user of debt structures, although some convertible instruments are used. But the equity market over the last 12 to 24 months has been nothing short of spectacular. We have come out of a very, very difficult and protracted market cycle back starting in 2008. We were treading on record lows, but there was a real sharp snapback over the last 2 years. There's a lot of equity capital deployed in the markets right now, and a lot still sitting on the sidelines, given where fixed income markets are trading right now. So there's a lot of opportunity to draw capital into these industries. So again, Dow Jones as of yesterday, was at 17,625, S&P over 2,000, NASDAQ at 4,600, and the NASDAQ Biotech Index, again at a 5-year high at 3,077. So what that means is we're in an environment where risk capital is being deployed, and to use the parlance from my old industry, the investment banking world, we're in a risk-on environment, meaning investors are willing to take and deploy risk capital, looking for some superior returns. So good context here. Capital markets now, what does that translate into? Accessing this type of capital are wide open. So in a year to date, in 2014, we've seen 248 initial public offerings price, raising almost $80 billion of capital. We still have some that are on file, between the 248 and the 341. So there's close to another 100 companies that are in the chute trying to get out. We'll see what happens before year end. But that's almost a 50% increase over where we were from the prior year. Of the IPOs, the 248 that have been done, 95 of them have been in healthcare. So you can see a real bias and appetite amongst investors towards this industry. That's broadly speaking, that includes services, device, pharma, biotech, and bioinformatics. And right now, the average IPO return based upon this class or this year has been over 13%. Compare that to where fixed income yields are. You can see that delta and that incremental return and why it's driving investor capital into this industry. So we have a terrific context right now with what's going on both in the broader equity markets and what's happening in particular within the capital markets for this industry. So let's talk a little bit about the private market. VC capital, which historically has been the lifeblood of this industry, is also flowing. Q2, we saw a total, this is all VC deployed, not just biotech, but technology, which is the preponderance of this. But we saw $13 billion in the second quarter alone being deployed by the venture capital community. And that spanned about 1,100 deals. And if we stay on that pace, it's a little lumpy. It's not a linear progression of how the capital's deployed, but it's likely by the end of 2014, over $30 billion of venture capital have been deployed in the U.S. market. This will, approach record-setting levels. As a subset of the 13 billion thus far through the first half, about 3 billion of that has been deployed in life sciences. So when you look at where we were, these numbers relative to historic activity were, topping back to 20-year highs, which we experienced back in 1995. So again, consistent with what we're seeing in the public markets, the risk-on mentality still exists here as it relates to deployment within this sector. Average deal size there is just shy of 13 million. Within the life sciences, if you look at that 3 billion that I noted a moment ago, 1.8 billion of that was biotech, and that amounted to 122 deals in Q2, and 649 million was deployed for medical device technology, totaling 73 deals in Q2. And whatever the difference is between the 3 billion and those numbers were for a variety of other applications, bioinformatics and things of that nature. Again, takeaway here is capital is flowing, risk-on mentality. The question that we're going to be exploring throughout the day is how do we begin to access that here for this portfolio of companies and in this marketplace. Let's break it down a little further. If we look at life science, and my definition here of life science does include biotech and medical device technology and bioinformatics. Early stage funding accounted for about 1.1 billion in Q2, totaling 100 deals. That was a 22% year-over-year increase. And you just compare quarter over quarter from second quarter 13 to second quarter 14, it was a 15% increase. Late stage funding accounted for 1.4 billion, totaling 95 deals in Q2. That was a 27% increase year over year, but a remarkable 90% increase year over year. So you can start to see how capital is being deployed vis-a-vis stage. And it's not linear and it's not constant. You'll see an ebb and flow in this between investor interest, and also it's a function of the companies that happen to be presenting to raise capital at that moment in time. This is an interesting factoid. First-time funding was down 20%. So meaning the VCs were saying, okay, we're not necessarily looking to add new companies to our portfolio, but we're reserving capital for our existing portfolio companies, and we'll continue to deploy and support those initiatives. And the corollary to this first-time funding is the follow-on funding number, and you can see that's up 34% in Q2. So let's take a look here at Medtech. Again, early stage funding for medical technology companies down 10%, and we saw a meager 169 million deployed over 24 deals nationwide. Late stage was up 41%, but that attracted again less than $500 million of capital spread out over 49 deals. there's been some weight in the Medtech sector, and I think it's largely attributed to the medical device tax that's been imposed on the industry, and some other issues surrounding reimbursement of new technologies. But this is an important issue because there's a lot of interesting medical device technology that comes out of the Los Angeles and Orange County markets here. Average deal size for early stage companies is just shy of 8 million. And interestingly, average deal size of late stage was only, just barely 10 million. Quite a contrast to that we see in the biotech space. So capital has been parsimonious going into the medical technology field. So I talked about this at the beginning of my remarks. What regions are attracting capital, and right now, I think as we know, the Bay Area remains the king of the hill there. They continue to attract the preponderance of capital, and they do that year over year. Boston ranks second. San Diego coming in, showing very strongly with third. New York also now has really burst on the scene, and I attribute that to some very coherent policies that have been developed under the Bloomberg administration to drive and attract companies into the New York metropolitan area. And that consisted of investment funds being created, tax incentives, and other cooperative initiatives. I was speaking with Jan last night after her remarks and her role as the head of the Economic Development Council here in Los Angeles. We'll be planning a follow-up meeting with her with some of the board members from SoCalBio to start looking at the examples of what's been done in places like New York and other locations that we can use as models to implement here. And then rounding out the pack, in 2014 was the Great Lakes region, which would consist of Michigan and Wisconsin, driving off of the research and development being done principally at University of Wisconsin and University of Michigan. We hope to see LA starting to emerge into this top 5 pack here over the next couple of years. But these are ecosystems that attract capital. It's the intellectual capital that exists there, which are driven around the universities. It's the entrepreneurs. It's investment funds. It's a whole cultural development that must occur in order to achieve this type of capital magnetism, I guess I'd call it. So what's the outlook as we go, as we close out 2014, which I think will close on a very strong note? As I've canvassed my colleagues in the venture capital community and on Wall Street amongst the investment banks, there's nothing slowing down. We're seeing filings continue to occur with respect to new public offerings. The backlog is quite strong at every major firm. And VCs are just being overwhelmed with initiatives and opportunities. So there's appetite on both the supply and demand side, which is very good news. The returns, as I've noted, have been good, both in the private sector and in the public markets. We're seeing investor liquidity, which is important to sustain a market, that people can get in and out of positions. And the whole capital markets ecosystem, starting from seed capital to exit, is restoring. What is key to that is a vibrant public market and a vibrant IPO market. We have that, and I think that will continue for the foreseeable future. We're also seeing portfolio managers increasing allocation to the sector. And again, the words that are rolling off of everyone's tongue is they're not looking for another Me Too products. They're looking for products and technologies that can scale, that are innovative, and truly disruptive. A brief comment on what's going on in the M&A and partnering scene. We've had and will continue to see strong appetite by the consolidators to acquire growth versus organic growth. The consolidators, by that I simply refer to as the large cap companies that have to continue to grow and add earnings and add new products and technologies. The Mercks, the Pfizers, the Becton Dickinsons, the Boston Scientifics of the world will all continue to seek to grow through acquisition. And that will persist over the next 3 to 5 years. I don't see any abatement in that. We've seen, though, particularly in Q2 and Q3, a bias towards the phase 2 and phase 3 assets for obvious reasons. There's proof of concept established, and also visibility to revenue with some of these types of programs. Phase 3 asset deals led the market in Q3, with an average upfront consideration being paid by partners of $83 million. And then P1 or phase 1 deals, which in 2013 and early 2014 were actually doing quite well. We were seeing some appetite for platform technologies. They took a sharp downturn in Q3, normalizing out to lower levels and an upfront consideration typically in that single-digit range. But again, the theme when I speak to some of the CEOs of the large cap companies, they're looking at, again, visibility to proof of concept, visibility to earnings, large-scale market opportunities. But interestingly, a common thesis I found was the convergence of life science technologies and high technologies, which means, in my mind, the integration of empirical, evidence-based, data-driven type of opportunities. Big theme and something that each of you within your own company should be thinking about how to empiricize and your results and your capabilities. So what does the ecosystem or the innovation capital system look like? No magic to this list here, but it requires a careful integration, and all these elements have to be in place in order for the ecosystem to restore and to be fully functional. Any one of these elements breaks, the ecosystem begins to break and falter and diminishes capital flow. So again, venture capital has been flowing. I would note there are two dimensions to venture capital. There's the traditional venture capital funds that we all know and love and have worked with. And then there's corporate venturing. And this is the large cap companies, the Mercks and Pfizers of the world, deploying their own venture capital. In 2013-14, we saw a real sharp rise of corporate venturing, and I think it has come close to equaling the capital deployed by the traditional venture capital funds themselves. And we'll continue to see that trend as companies look to invest directly rather through intermediaries such as VC funds. Hedge funds obviously are key participants as you get into the public market. They're active buyers in new issues. They're liquidity providers in secondary market. But we're also seeing some activity by the hedge funds moving into late-stage privates. Funds like OrbiMed and others participate there. Crossover funds play in both VC and the hedge fund world. Mutual funds are vitally important, particularly for the public companies. But again, even within some of the large mutual funds like T. Rowe Price, we see some pockets of capital that they can deploy for special situations in private companies. Foundations and affinity groups are becoming new players here. So these are patient advocacy groups and foundations that have a vested interest in a particular disease category are starting to deploy capital directly into companies. The Leukemia and Lymphoma Foundation is one prime example of that, where they've made direct investments. And as I've met with foundation CEOs, there's an emerging appetite for them to further sponsor research that supports their own mission. Crowdfunding. We've been talking about that for the last 2 years. The SEC is finally providing additional clarity on how crowdfunding will work and the ability to sell equity. I'm also a board member of a crowdfunding entity called Polywog, and we can talk more about that either on the panel or throughout the day. But crowd funds will be, I think, the next generation of angel networks or super angel networks. And these crowd funds will tie into foundations and affinity groups. Finally, we have angel networks that have been an important source of seed stage capital, Tech Coast Angels being the most prominent example here on the West Coast. I think they will continue to function, although I've seen the angel networks tend to drift up market a little bit and look to later stage opportunities rather than traditional seed stage or A-round opportunities. And finally, I threw this little acronym BDCs on the bottom of it. BDCs are structures known as business development corporations. These are publicly traded vehicles, historically used by a lot of the large private equity firms to raise capital in the public markets. These are closed-end fund structures, and they've typically been yield-driven instruments for buying real assets, so real estate and other hard assets. But they've been very yield-driven. We have, to the best of my knowledge, have launched, currently on the road as of yesterday, the first true equity BDC focused on life sciences, and it's a pure equity investment. So think of it as a publicly traded venture capital fund if this succeeds. The red herring went out yesterday. It's targeting regenerative medicine, and we're seeking to raise 100 to 150 million in that fund. If that occurs, again, I believe it will be the first of its kind and begin to create yet another structure of venture capital that can help support the industry. So again, this comprises, in my view, the innovation capital ecosystem here that I would encourage each of you to think about where you can best intersect with these different providers of capital. And what's the key theme here? If there's one theme that everyone should kind of lock into their mind, whether you're providing medical products, devices, pharmaceuticals, biotech, bioinformatics, is value-based healthcare. Can you demonstrate that you're getting bang for the buck? Are you doing it better, smarter, and cheaper? Can you bend that cost curve? Can you improve outcomes? These all have to go into the calculus, but you've got to start from that perspective and work backwards as you define your own value proposition. And finally, what's the next big thing? I think it's LA. The initiatives at SoCalBio, I think, have been the tip of the spear, trying to bring together a lot of these initiatives under Ahmed's hard work and leadership and a terrific board. The LA County initiative, which I'm sure you'll hear more about, was just approved unanimously that, again, Ahmed had led. That was a result of the Battelle strategic planning study. So hopefully we start getting some coherency and support between government and private sector. And then we've got just a wealth of intellectual capital resources here with UCLA, SC, Caltech, LA Biomed, UCI, Cedars, and others that are the basis to give rise to new innovations, new technologies, and great new companies. So I'll pause there, and I think that's maybe set the stage for the panel's discussion.
Thank you, Joe. Why don't you join us? And if you want to follow along at what our panel's on page 10, and my panel members have been very kind to seat themselves in the order in which their names appear in the program. So next to Joe is Alex Arrow, who's the CMO of BioLays. Next to Alex is Chris Lawrence, Director of Research at New Medicines. And lastly, but not least, is John Smither, the CFO of Kythera. And gentlemen, if you could just take a minute, and you too, Joe, because I gave a very brief introduction of you, just to give us a little bit of an understanding of what your company does.
Okay, sure. Thank you, Michael. So I've spent my entire career in the financial community and capital markets for the healthcare sector. I started my career as an investment banker with Dean Witter Reynolds, one of the major brokerage firms, investment banking firms, that later merged into Morgan Stanley. And as I built my career out, I concluded that as the founding managing director at Jefferies & Company, again on the investment banking side. I transitioned into venture capital about 5 years ago, but all of my activities have focused in the healthcare and life sciences space. I've had the privilege of working with startup companies to then Merck and Amgen as my clients. Raised over $20 billion of capital. And in our current configuration, we work with, which is Brightwater's Capital. There's a principal and venture capital element to what we do. We work with top-tier academic medical centers and launching companies. We've worked with UCLA most prominently here, but we're also working with USC now. We've worked with other institutions across the country, including Johns Hopkins and Harvard University, in launching companies. And then we have also an investment banking capability to work with our own portfolio companies, as well as on a select basis, some other companies to raise capital or advise them with partnering or merger opportunities. So that's me. Thank you.
Thank you. I'm Alex Arrow. I started my career as a surgical resident, and then I left the hospital in 1996, never to see another patient. I became a medical device sell-side analyst, where I was a publishing analyst for 9 years, and then since then have become a medical device manager. So I've now spent slightly more time as a CFO, CMO, and President and Chief Operating Officer of medical device companies than I did as a sell-side medical device analyst. So I'm more of an operator at this point. I'm here on the panel today representing two companies because I'm the CMO of BioLase, which is the world's lead selling manufacturer and distributor of dental lasers. These are lasers to replace the high-speed drill for general practitioner dentists and periodontists as a cutting tool, which has had a colorful fundraising history, especially in the last 2 years, that probably has examples that we can use on this panel of how to and how not to access the capital markets. I'm also on the board of a cardiovascular diagnostic startup, which is a spinoff from the Cleveland Clinic called Rindex Medical, which is private, pre-Series A, and has been entirely self-funded to date and has a few lessons for a startup looking at venture money.
My career is basically as a drug hunter. I put 16 small molecules, biologics, into clinical trials. 8 of those are still going through clinical trials at the moment. But for the last 3 years, I've been at New Medicines. This is a clinical stage small biotech company based in Pasadena. We are primarily developing interleukin-12, which is a hematopoietic and immune system stimulator. It is being primarily funded to date from BARDA, part of the US government. We've received funding or non-dilutive funding of $66 million to date. It is to develop interleukin-12, or Hemamax as we call it, as a radio mitigant, as a countermeasure. But additionally, we now want to expand IL-12 because it has pronounced effects on some of the key cells involved with oncology. So our funding now is to try and gain money for those clinical trials in oncology, having developed over the last 10 years a very successful, as I said, radio mitigant or medical countermeasure that is now in healthy volunteers in phase 1B clinical trials.
Good morning. My name is John Smither. I'm the Chief Financial Officer of Kythera Biopharmaceuticals. We're up in Westlake Village. We're a little bit of a different play. Our focus is in aesthetic medicine, so if you're familiar with products like Botox, Juvederm, or Restylane, we're targeting consumer pay market. Our lead drug is something called ATX-101. It's a fat-killing drug that you inject in the submental fat area, which is directly below the chin. If you're paying close attention to me, you know I have not been in our trials. We're currently on file with the FDA. Our PDUFA date is May 13th. We are a publicly held company. Like many of you, we have gone along this path. We did 4 private rounds. We did a licensing agreement. We did our IPO in 2012. We did a follow-on in 2013. We're right on the cusp, we think, of actually being on the market, and hopefully with a little bit of luck, we'll actually have revenues this time next year. And as a side note, I also serve on the audit committee of a public company up in the Bay Area called Achaogen. By background, I'm a CPA, so they always tap the CPAs to usually head up the audit committees.
So for those of you who don't know, Kythera's one of our SoCalBio success stories. Was spin out, some of the technology spun out from LA Biomed, a couple of collaborators, Michael Kolodny, Adam Rotunda.
At Harvard UCLA.
Yeah,
Yep.
Came here many years ago, and as a result, we now have this great company here in LA. And as Joe asked the audience, I'm sure there were people back at that conference, probably Adam and Michael, wondering, how to start things up and raise money. Everybody here is pretty much early.